Welcome to the Value Investor Podcast. This podcast helps you grow your wealth and become financially independent. My name is Becco, and my partner, Hari. Good to see you, sir.
Morning.
Good, sir. Good, sir. Nvidia. We're continuing our discussion on Nvidia. In this episode, we're going to be talking about their financials, their management, and valuation. If you haven't checked out the previous episode where we talk about the business, go ahead and check that out before you come to this episode.
And before we begin, we're just going to give you the disclaimer one more time. This is for entertainment and education purposes only. What we are discussing here, we don't know your financial situation. We don't know your personal thing. We're not your financial advisor. So take everything we're here into consideration. But you have to do your own research and your own decision making before investing.
And we'll talk about why that is in terms of why you have to do it yourself more in detail when it comes to valuation.
Yeah.
Okay, let's move on down the checklist. Also, we're going through a value investors checklist when we analyze companies like Nvidia. So if you don't have a checklist in front of you or didn't have access to it before, send us an email at info@valueinvestor.org for a checklist. We would be happy to send this out to you guys so that you can have it, read it through it. That'll help you kind of frame your mind in analyzing companies and understand what we're going through here in this podcast. Okay, let's move on to the financial. Right off the bat, we asked this question. Is the company able to translate its moat into high returns on capital? And we talked about moat in the previous episode. That's one of the last topics that we talked about. But is it able to translate that moat into high returns on capital? Returns on capital can be described in many different kind of ratios. But we like to stick with ROE, ROIC, ROCE. There are many different flavors, but these are kind of the general returns on capital ratios that we like to use.
So, and all of these are just basically telling you how profitable is the company.
Yeah.
Right. And so the more profitable they are, the less money they have to invest in order to make, another dollar. So,
yeah, exactly.
The higher the number, the better.
Also, I want to give a plug in here. If you haven't listened to the valuation ratio, do check that out because we cover all of this. ROE, ROIC, ROCE, all these things, valuation ratios, operational ratios, all those ratios that we use have been covered by previous episodes. So please check that out.
We won't define them again, because I think it'd be better for you to listen to those first if you don't know.
Okay, let's dive into the numbers here.
Yeah.
So if you look at 2018 number for ROE, it's incredibly high. It's 40%, 41%. I mean, think about that. 41% ROE. That's really high. But if you only looking at 1 year's number is very deceiving. That's why you have to look at all these different previous years. Maybe average 5 years worth of data or 4 years worth of data. You got to look past just 1 year. So if you do that, it tells kind of a different story here. Starting from 2014, I'm going to read you guys out loud return on equity from 2014. So 2014, it was about 10%. 15, it went up to 14. 16, about the same. 13. 17, it went down to barely sub 1%. And then 2018, it just exploded. So on average, I haven't done the calculation, but average, I don't know, say
it's probably low 20s.
20s, yeah. 20% ROE. And then return on invested capital, return on capital employed, they're drawing kind of the similar trends here. They start very low, one single digit, and then explodes up to 51% for return on invested capital, return on capital employed, 30-something%. So just it has this hockey stick, exponential growth for all these different numbers.
Well, and that a lot of that is reflected in the last year's. 2018 was a banner year for them.
Yeah.
Cryptocurrency was at its peak. There was a lot of purchase of these GPUs. So they were really, what they were doing was leveraging, what was a gaming, card was now being bought in, record numbers. So there was no additional investment, which is why the profitability number went up.
Yeah.
From a high level, that's what what you're seeing is reflected in that percentage is essentially, they did all of the R&D, and instead of selling 100 units, they sold 500 units, right? So it was a lot more than was normally present, and that's why that profitability number went up. Cryptocurrency is kind of fading away, but I think what it's being replaced by is a lot of the data center stuff. So I think looking forward, this profitability number will probably be closer to the 25 to 30 range than the traditional historical number.
Yeah.
So that's the important part of this measurement is it's not just looking at what it was historically, because 4 years ago they're a different company, and looking at it now, I think they're going to be able to maintain a higher level of profitability, which is obviously a fantastic thing, for them and for their shareholders. But I don't know that I would say there isn't a lot of operating history at this point to know that, right? To know how long that can last. But I do think that the future for them, the next 5 to 10 years, the near term, data centers are going to be buying GPUs. Gaming is going to still be very popular.
Automotive industry
is going to be growing heavily. So I see a lot of future places for them to leverage the chip that they build once. Now they're selling into different industries, which translates into higher profitability. So I think that's a very good sign for them.
Yeah. Yeah. Again, we talked about the technical edge as one of their moat, and clearly we see here in the most recent years, maybe starting from 2015, 16, you can see that they have been able to translate that into high returns on capital. And the question is, will they be able to continue this? So that's kind of where your judgment comes in to play. Okay, let's move on to the next question.
Yeah, so looking at the financials, does the company have enough cash to maintain its business?
Yeah. Let's talk about the cash on hand. Cash equivalent, or marketable securities. So in 2018, they have about $7 billion worth of cash equivalent. So straight up cash, they have about $4 billion, and marketable securities about $3 billion. So I mean, that's plenty of cash they're sitting on. In terms of liquidity problems, they don't really have a liquidity problem. They have commercial paper available, revolving credit facility available. I mean, virtually every company that's operating have all these lines of credit to be able to supply the liquidity they need to grow. So that's not a problem for them. But the key question, you're going to say something?
Well, all I was going to say is what we're really looking for is this going to derail the business, right? Are they not going to be able to function because they don't have enough cash and other things on hand? The only reason that you would really have to get into the details here is if they're close to having a problem. Yeah. And I don't think they're there.
Yeah.
So,
and if you look at, to Hari's question, are they going to go out of business? Is there impending gloom and doom coming from the horizon? So you have to look at the debt levels. If you look at the debt level, see, in 2018 they have about $2 billion in debt, long-term debt, and then 2014 about 1.3, and then the debt level I believe it spiked in 2014. But if you look at debt to equity ratio, about 20%, 26%, 2018 has been around 30% for the past 5 years. If you look at debt to free cash flow, right now, 2018, it's below 1, so 0.68%. So they're in good financial health. The current ratio, which is kind of the money that you need to kind of run the business now, they're doing well here as well. So I don't see any impending gloom.
Yeah.
In the horizon.
I mean, a recession may have a big impact because gaming cards and stuff like that are kind of they're not a staple. Yeah. People will forego purchases in a tough environment. But I also don't see them. They have enough cash on hand to weather a recession, so I don't see that being too much of an issue for them.
Mm-hmm.
So
Yeah.
So let's move on to the management discussion. So
Yeah. I think management is quite interesting. We talked about this before the podcast, how transparent they are with their management incentive.
Yeah, and I'll tell you that they are probably in the top, 5% in terms of being transparent about that stuff. It's very refreshing to see that. And I'm also, a big fan of their CEO. This is people talk about a lot of CEOs as being flashy and things like that, but Jensen Huang is a very interesting guy. Like, he founded this company, still works there, still the CEO.
There,
and smart guy, and so let's ask the questions. Is management properly incentivized to protect shareholders' interests over its own?
Yeah, it's interesting. If you look, Hari's talking about, you're talking about the transparency. They say this. They say in fiscal year 2018, performance-based compensation represented 92% and 57% of the total target pay of Mr. Huang and other non-executive officers, respectively. So in terms of the alignment of the executives with the shareholders, they are pushing aggressively to make this happen, and they have made it happen, but they're pushing it further to 100%, stock-based compensation, performance-based compensation. And so what I would say to your question about, is the incentive structure aligned with the shareholders? And I would say definitely yes.
Yeah.
Just look at, 92% percent at risk pay for a CEO is 92%.
Yeah, so when they say that at-risk pay, that means performance-based. So it's not a guarantee. He has a base salary that's guaranteed.
Yep.
And then if he doesn't perform, or if he performs above the expectations, then he gets a layered, thing. And this is uncommon to see, like how they've structured all of this and how they've laid it out. And they actually surveyed, the top 20 of their institutional holdings, and asked them, "Do you think that this?"
Yep.
They weren't required to do so. They just did that on their own.
Yep.
And I think that's that's admirable for them, to do so, because I think what it really reflects is their commitment to being transparent with how their pay is going. So what I would tell you is, when I see things like this, that makes me very interested, right? For one, that I love companies that make a very concerted effort to be friendly to their shareholders, which I think that this company has done very well.
Yeah. The CEO already, like Hari said, he founded the company. He owns about 4%, 3.87% of the company. So,
as far as I know, the majority of his net worth is tied up in this investment. So
exactly.
If you're putting your money down with, you're investing alongside the CEO.
Yeah, exactly. And one of the things that I want to touch on is this. It is percent at risk pay for performance, but the measurement of performance might be erroneous, for example, right?
Right.
So you have to look at, okay, how are they being measured? Like, what are they looking at? And I dug into their 10K and found this. So they're measured on 3 different verticals. One is revenue. Second is non-GAAP operating income. And then the third one is stock performance, the actual stock performance. So what do you think about those?
So I certainly think operating income is the right target for them to go for. Revenue, I think, is harder, right? But they're not in an industry where they can kind of force revenue. They sell what they can sell, right? And that's like, after cryptocurrency kind of blew up, or collapsed, I should say, is a better term, they can't force people to buy their cards, right? It's not, so that's not the best target for me. I would say if they've put everything on operating income, I would be very happy with that, because that really reflects, are they controlling their costs? And that's the number, because they can't control their tax rate, and they can't really control much in the interest that they have. But so we wouldn't want to look at net income. And I'm also not a fan of stock performance, right? Because I think what what happens with stock performance incentives is that you can kind of financially engineer stock buybacks when the price is still already high, just to push it a little higher. And I would prefer them to actually buy back shares when the stock price is low, which is a better use of capital. But I'm not opposed to their plan.
Yeah,
right?
yeah.
I mean, I think it's very transparent. It's reasonable, because revenue targets is something that he can't engineer. The only thing in this really is the stock performance, which clearly he didn't engineer it well enough, because it dropped from like 300 to 120 or so. So I would say there's nothing that I'm too worried about there.
Yeah, and kind of I think that's a great segue to excess cash management.
Yep.
Again, excess cash, like Hari said, you could have these excess cash and engineer the stock price by issuing a huge buyback, and therefore elevating the stock price artificially. But here's what they've done. So with excess cash last year, they returned about $1.25 billion to shareholders in 2018 through a combination of share buyback and dividends. So about $900 million in share buyback and $341 in quarterly cash dividend.
Yeah, so that's about half of their free cash flow is what they're I'm sorry, proposing in the future is what, comparing it to 2018's numbers, they're saying they're going to do another 1.25.
Yeah, in fiscal 2019 they're going to do another 1.25. Yeah, exactly.
Yeah,
quarterly dividends and share purchases. Yeah. So that's how they manage cash. Any kind of commentary on that?
Well, I think the only thing that I would say right now is let's talk a little bit about the valuation first, because that's where this kind of gets more difficult. I think we posted this on our Skechers article on Seeking Alpha, and some of the comments were around the discount rate that we used, that we were too conservative with the discount rate. So if I can speak to that for a little bit,
sure.
I think what I would like to say in regards to that is, the reason that we are so conservative is that we have an absolute threshold that we have to cross. It's not related to interest rates. It's not related to anything else. The discount rate to us, and there's debate on what discount rate to use and all that, is the discount rate is in my mind is the opportunity cost for investing in something else, right? So I follow what Warren Buffett preaches, because I think he's the best investor on the planet, right? And his philosophy is that it should be the return on equity of your next best investment. So if it can't beat that number, then it's not worth it, right? And so that's why his discount rate is very high. So to me, the safest, mostly safe investment is the S&P 500, which has historically returned about 9 to 10%. So we just used a 10% discount rate. That number may be low to some and high to some, people, but I'm not going to waver from that. It has served me well for, 20 years now. I think the thing is that when you look at our growth rate estimates for Nvidia that we're going to present, they're also very conservative. And the reason that we do that is that people are going to say, well, then you're never going to be able to buy anything.
They're going to find one, yeah.
Yeah, and so what I would say is, when it's raining gold outside, I don't want to be walking around with a thimble, right? As Buffett said in his last, 2 years ago in his annual letter. I'm willing to wait in cash until, something really compelling comes along. And that may mean that you listen to a lot of these podcasts and you find at the end of the rainbow there is no gold, because it doesn't meet the threshold. And what that means is that you're going to get a higher rate of return when you invest, because you're being more conservative with your estimates. Nvidia may explode, and they may shoot up to $500 a share in the next 5 years, and you're like, you look like a moron because you didn't invest. I'm willing to make those, to take those those risks, because I'm not interested in making money. I'm interested in not losing money. That is my number one priority, when we invest. Right, is rule number one, don't lose money. Rule number two, don't forget rule number 1. So when we talk about this stuff, we use conservative estimates. If you want to use a lower margin of safety and a lower discount rate, by all means do so. But that's your decision to make. This is how we evaluate companies, and this is how we invest. So, and that may mean that we only have one good idea a year, and I'm totally fine with that.
Yeah.
It will also mean 3 years we have no good ideas.
Yeah.
I'm also totally fine with that. So,
one or two really good ideas will do it for anybody, really.
Yeah.
Yeah. Okay. So let's dive into the actual valuation that we have done.
Yeah.
You want to pull up the let's pull up the discounted cash flow model right here. So we put in we're again kind of going off of what Hari talked about. Growth rate, we're going really conservative to 20%. Again, they've been growing at pretty aggressive rate recently, but about 30%. But we want to make sure that we stay conservative with those estimates because, the cryptocurrency bust happened and we don't know what's going to happen. We think that it's going to grow quite a bit. I mean, 20% is still very aggressive for 3 years.
Yeah,
that's aggressive. But still, we don't want to overshoot.
Right.
So we put in 20% for the first 1 to 3 years, and then rest 4 to 6 years about 10%, and then last 3 years 5%. And then discount rate here again 10%. And we run the calculation, and we get about $65. This is after debt and then adding back cash. So $65 per share. And again, this is not an exact science. You can obviously fool yourself by lowering the discount rate, by hyping up the growth rate and all that. But that's kind of our take on this. About 65% is what I would say a comfortable intrinsic value for this company.
Yeah, and I think one of the things what is hard about this. So first of all, I want to say one thing.
Sure.
At the right price, this is a slam dunk buy.
Yeah.
Right. I have no questions about this company in terms of moat, in terms of long-term prospects, in terms of anything, really. Yeah. Right. But my only concern is that I'm a value investor. Price matters to me, right? And so if I were to assign them a 25% growth rate for the next 10 years, right?
Yeah.
It still would not be enough to justify their current share price, right? Yeah. I wouldn't have a significant margin of safety, right? And so
yeah, go ahead and put in like 30 for the whole 10 years.
Yeah, and at 30, you're still looking at a current intrinsic value of $140 a share.
So right now it's trading at what? Right now, let's see. Give us a second to
about $150 a share.
Yeah, $150. So that price is justified if this company is able to grow at 30% for the next 10 years. So every single year it grows at 30%.
Yeah, which, I mean, let's be honest, it could actually happen.
It could happen, yeah.
But it still, doesn't have enough of a margin of safety, right? And to me, that's kind of the where I see this being is whenever the next recession happens, I have Nvidia on my checklist or on my watch list.
Yep.
And if it falls, I'll redo my calculation, my value calculation. If it falls below that threshold and there is a good enough margin of safety, I will buy with both hands, right? I'll put all of my money in, and I'm willing to say 30% of my portfolio I can put into this company because I don't really have any questions about management or moat or any of those things. All of those things are a slam dunk in my mind. You may have a different opinion, and you may have more inside knowledge or whatever.
Yeah, or you may not know about this industry at all.
Yeah, but
outside of circle of competence.
But really, I consider myself fairly knowledgeable about the graphics market and the industry, and they're a solid company, right? I can't say anything really too negative about them. I just can't justify a purchase at this price, right? And so, you can play with the numbers and make some, fool yourself into thinking that, right? But you could have also said at $250 or $300 a share, oh, I mean, they're just growing like crazy, and it's going to go on forever. And then the share price drops by 70%, or 50% rather, and you're left holding the bag, right? And so that's why that's so important, right? Is that we have to be fairly rigid about these kind of things because, and you can play with the numbers, you can figure out what you want to say, but I would say it's just a little bit too pricey. Even at this price point, if it's below $100, I'm a lot more interested in this company.
Oh yeah, I mean, if it dips below $100, that's very interesting right there.
Yeah.
And again, I think you might want to touch on the discount. Again, kind of going back to what you talked about earlier in the episode about, we can't make these judgment calls for you whether to buy or sell. Is because when you run this calculation, you're putting in your own discount rate. Yeah. Discount rate being your next best opportunity.
Right.
And so whatever your next best opportunity is, be it, I don't know, for example, Google or whatever, or whatever your next best opportunity is, what is that return? Put that in here.
Right.
And do the calculation yourself because we don't know your financial situations.
Right. And we also don't know your circle of competence, right? Only you know that.
Yeah.
And so you wouldn't, you may have a great idea in a sector that we have no knowledge of.
Exactly.
And have evaluated a company and you've seen a good rate and it's a solid business.
Mm-hmm.
I think Warren Buffett actually uses Wells Fargo as his yardstick in a lot of ways. They have a very high return on equity of 15%. 16%. It's way up there, especially for a bank. And so his yardstick is always, if I'm going to invest in this company, I have $1 to spend. I could also just put that dollar into Wells Fargo.
Yeah.
Why wouldn't I?
Yeah.
And so that's kind of his thought process is always around that.
Yeah.
So and look, let's be honest. The difference between being strict about this and you lose money a couple of times, it can wipe out a huge, amount of gains that you get. A 50% loss, you have to now double your money to get back to that, right? Which is why we want to be very conservative about all of these estimates and these valuations, because when we find something in that range, we're ready to pounce on it.
Yeah.
So
exactly. Okay. So that was Nvidia. It's a pretty exciting company. A lot of things going for itself. I think bright future ahead. But I think for us, the problem here is the valuation.
Yeah.
It is a little too expensive for our taste, but go and do the exercise for yourself. See what you find out about Nvidia, and email us and exchange with us.
Yeah.
If you have any comments.
Love to have a conversation about it.
Yep, absolutely. Okay. Thank you guys for listening. This episode 40. Think about that. It's a big milestone for us right there.
Yep.
Okay. Again, reach out to us at info@valueinvest.org for any questions or concerns. And okay, I'll see you on the next episode.
All right. Thanks.
Thank you.